Also, last month, one of the things that happened was that on the long end, in the ultra long end,
Right.
it was one of the few times historically where the long end didn't come back on the stock market sell-off.
Right.
Because why? Because the money was going to the short.
Correct.
To the short end of the market.
And I've seen some fixed income managers. In fact, we have a fixed income manager on one of our ETFs, HAD, which has actually been one of the few ETFs in Canada that's managed to sort of keep its head above water on this. And they've started to move long, because really where the focus, the risk is in sort of like this 3 to 5 year range on the bonds. But moving past 5 years, well, people are now starting to worry about where we are in a late cycle market and recessionary environment. So the long end of the curve hasn't been hit to the same degree. I as an ETF provider, I sympathize with investors, because there's a lot of questions here that, again, I say winter's here, and interest rates are here. It really is kind of bringing things to the forefront. And how do you manage your portfolio to do that?
On the macro side, the other thing that's changed is that, with China, with the U.S.-China trade spat that's going on, this trade war, it's definitely putting pressure on the bond market as well, is it not?
My understanding, though, is Chinese sovereign bonds still trade extraordinarily tight. I think they're only about 30 to 40 beeps maximum over Canadian and U.S. bonds.
Yeah.
So that's actually still a fair amount of risk relative to the size of their market. Whereas what you've seen is people worried about a contagion effect. So if you have an economic crisis in China, which wouldn't really be precipitated by the government side, it's actually on the corporate debt side. When we talk about zombie companies and shadow banking, we don't know how much corporate debt's in China. And if there is a big issue where, revenue starts to dry up from trade war and then corporations start to default, that's a huge powder keg. But China itself, their bonds haven't been hit, to my understanding, and this is the opinion of Fiera again, but it's already trading tight, so it's probably a risky proposition. But the rest of the global emerging market bonds have really been hit hard. Huge sell-off in emerging market bonds. Yeah. And in some ways that's a little bit unfair, because while you're talking about something that's specific to China, some of these other emerging markets, particularly Latin America, the risk is really priced in, and now you're getting yields that are 8-9% in some of these regions, and
wow.
And so there's a bit of a risk-reward trade-off. Yeah. Again, are you looking for an alternative to high-yield bonds? Well, it might actually be in those emerging market bonds where they've been beaten down so much that your compensation to be in them is probably decent relative to their economic growth. And a lot of the balance sheets of Asia, Indonesia, even Argentina, for example, they look a lot better than they did 10 years ago. There's a lot more focus on fiscal policy, monetary policy to support their bonds. Obviously, Turkey's an exception to the contrary of that. Whereas somewhere like China, that risk on their sovereign side really hasn't been put in. And I don't know any, the corporate bond stuff is obviously very interesting, doing due diligence there. So it is a huge risk factor to be in that space. But at the same time, you are getting compensated on much, much higher yields. So again, in that quest to 4%, what's riskier right now? High yield bonds or emerging market bonds? And some people might argue it's the high yield bonds relative to the emerging market bonds because of the fact that some of the risk on the corporate balance sheets, particularly in triple Cs, which is the low end of the risk spectrum, maybe isn't priced in.
What are your thoughts on the opportunity in emerging market bonds?
Well, I'm going to take cue from Fiera again.
Yeah.
They're viewing it as the way to get your yield carry right
It's
now.
opportunistic.
Yeah,
they've been beaten down, because the yields are there.
And economically, what's happening is there's such a myopic focus on the trade war. It tends to ignore the fact that economically things continue to move well. Now, if they slow down a little bit,
there's a higher risk premium.
Yeah, much better. And it's coming from the fact that economically the world's still net positive, and there doesn't seem to be a real driver of slowdown on a go-forward basis. Likely the trade war concerns, specifically between China and U.S., could do that. But in the meantime, the world seems to be in full recovery from the financial crisis.
Yeah.
And so again, when I talk, as being an investor, the concerns about a global trade war and tariffs doesn't seem to be as big a concern, as big an event outcome as this sort of synchronized global expansion. So if you believe in the synchronized global expansion, then you're being given a gift to invest in the emerging market bonds relative to if you believe in, these trade wars is likely priced in.
Canada is supporting a much higher spread over the U.S. So what are your thoughts on that?
Well, again, you have to think, and just going back to what we saw with the interest rates. I mean, interest rates are bad for bondholders, and Canada's been slow to raise rates relative to the U.S. At the end of the day, historically, Canada can't have a huge spread between the U.S. in terms of the interest rates it offers, because if foreign investors who make up the bulk of bond purchases, they have to go and make a determinant, do I want to own Canada or a U.S. 5-year? And if I'm getting a U.S. 5-year, 75 to 100 basis points more, well, that's a no-brainer trade from an asset allocation standpoint. So at a certain point, Canada has no choice but to keep pace with the U.S. So what happens is that even if you think that the U.S. is going to hit a wall after, I guess the market's pricing in, my understanding is about 3 more interest rate increases, including one in December likely. If you think they're going to continue to raise interest rates, then you kind of have to think that they're going to stop maybe after 3 or 4, and they probably reach their elasticity in the economy. But Canada, is behind, so you're likely seeing maybe even additional rate raises during that period, which means that U.S. might actually be more attractive from a total return value versus Canada, because that interest rate pressure likely stops before it does in the Canadian market.
Okay, so the U.S. Treasury market, U.S. bond market, more favorable.
And especially in the U.S. corporate market too, Just getting a higher yield.
In the near term. More favorable in the near term.
Over the long term, you see them converge.
As spreads normalize. Okay. Emerging market bonds, great opportunity relative
to
risk
high yields.
Reward. Okay. And investment grade over high yield.
Correct. And just because of that corporate challenge. So these things always change dramatically, but it is fun. It is fun and interesting to see that we have to now figure out what do we do, how do we get that fixed income portfolio out of the red.
Mark, it all makes sense to me now. Thank you very much.
No problem.